So imagine reaching into your winter coat pocket and finding, like, a crumpled $10 bill.
Okay, a nice little surprise.
Right. But you forget about it, and then a year later, you reach into that exact same pocket and pull out over 150 bucks.
Yeah, that sounds like actual magic.
It does. But that is exactly the kind of reality-bending math that investors in a company called Applied Optoelectronics Inc. are dealing with right now.
Yeah, it really is. It's the kind of price action that completely rewires how people think about their portfolios, honestly. Applied Optoelectronics, they trade under the ticker AAOI, and they have basically become one of the most polarizing equities on the entire market.
Exactly. And that's why today we are doing a complete deep dive into the mechanics of this company to figure out what is actually going on under the hood.
Because the market is, completely fractured on this one.
Right. One side is screaming that this is a generational strong buy, like a company perfectly positioned to fuel the massive AI boom.
And the other side is aggressively warning that it's a textbook value trap. They're seeing massive structural sell signals and basically waiting for the rug to get pulled.
Which is wild. So before we unpack this, you know the drill. You have to like this video, subscribe to our YouTube channel, and honestly, it is compulsory that you leave your feedback in the comments today.
Yeah, the debate on this stock is huge, so we need to hear where you stand. But just to set our ground rules before we get into the weeds here, this is a purely analytical deep dive into the data.
Right. Definitely not financial advice.
Exactly, not financial advice. We're just here to translate the raw numbers, the filings, and the chart so you can see the actual structural mechanics driving all this volatility.
Okay, let's unpack this. We have a mountain of sources today. Market data, SEC filings, insider trading logs, and like a really divided set of analyst reports.
A very divided set.
Yeah. So to really understand the hype, we first have to look at the raw momentum driving the stock right now.
Yeah.
Because the price action is just, it's dizzying. As of our data from April 10th, 2026, AAOI closed at $150.60.
Which is staggering when you pull back and look at the 52-week range. I mean, the low was $9.71.
Unbelievable.
And the recent all-time high hit $154.75. So you are looking at a 454.7% surge year to date.
Over 450%. I mean, that is just a rocket ship. And it's not happening quietly either. The volume is massive. Nearly 22 million shares changing hands.
Right, which tells us this isn't just a few retail day traders hyping it up on a message board.
No, 22 million is way above their average.
Yeah.
That is heavy institutional footprints.
Absolutely. And when you look at the technical picture, the trend direction is just aggressively, unequivocally bullish. The price is blowing past every single moving average we track.
Give us the numbers on those averages, because it really paints a picture of how overextended this is.
Sure. So the 5-day moving average, which is basically the short-term heartbeat of the stock, is way down at $119.
Wow.
The 20-day is at 103. The 50-day is around 84. And the 200-day moving average, the long-term baseline, is all the way down at $49.48.
Okay, wait. So it's trading at 150, but its long-term average is under 50 bucks. That is the definition of overextended.
It really is, and the signals reflect that tension. On one hand, you have serious short-term strength. The MACD made a positive cross at 3.78 on April 8th.
Which basically tells trading algorithms that the momentum is still actively accelerating, right?
Exactly. It's a classic buy signal for momentum traders.
Right.
And this is a massive, but the RSI, the relative strength index, is sitting at 71.68.
Ah, okay. The RSI. I always like to think of the RSI as like the tachometer on a car's dashboard.
That's a good analogy.
Yeah, so anything over 70 means the engine is in the red line. It's moving incredibly fast, and the momentum is totally real, but it's technically overbought.
Right, it's running too hot.
Exactly. If you keep a car redlining for too long without downshifting, the engine just blows. It usually needs a period of short-term consolidation just to avoid burning out. So if the engine is redlining right now, where is our safety net if it stalls? Where are the actual support levels?
Well, the immediate resistance, the ceiling it needs to break, is that high of 154.75. But if it stalls and drops, your first structural downside support is at $128.02.
Okay, that's a bit of a drop. What if that breaks?
If that fails, the next level is $118.70. But the major floor, the real historical safety net, is all the way down at $94.52.
Oh, wow. So it dropped from 150 down to 94. That's brutal. which means we really need to look at the business itself. Because a soaring stock price demands a soaring narrative, right?
It absolutely does.
But does the actual cash flowing through the business justify an $11.32 billion market cap? Here's where it gets really interesting. What is the actual catalyst here?
The main fuel behind the rocket is artificial intelligence. AAOI recently secured a massive order, over $200 million, for their 1.6T transceivers, which are specifically used in AI workloads.
$200 million, that's a huge contract.
Huge. And to handle it, they are massively expanding their U.S. manufacturing footprint down in Texas. Management is even out there targeting a bold $1 billion in total revenue for 2026.
$1 billion. Okay, that's the dream.
Okay.
But let's do a financial reality check, because the actual Q4 2025 filings tell a slightly different story.
Yeah, they do. Let's contrast the hype with the income statement. So Q4 revenue was $134.27 million.
Which is good. That's a roughly 34% year-over-year increase.
It is good. And annual revenue hit about $455 million. But here is the problem. Net income was still negative. They lost $2.02 million in Q4, and the estimated loss for the full year is over $38 million.
Right. And looking at the EPS, the earnings per share, it was negative 1 cent for the quarter.
Which is funny because Wall Street actually expected a loss of 12 cents. So technically, that negative 1 cent was a massive beat.
A beat on a loss is still a loss, though, and their trailing 12-month EPS is sitting at negative 63 cents.
True. But to be fair, their balance sheet isn't in distress. They have total cash sitting at $206 million.
Okay, so they have a runway.
Yeah, solid runway. Their debt-to-equity ratio is very manageable at 0.18, and they have a healthy current ratio of 2.63. They are not facing a liquidity crisis tomorrow.
And this is the stinger we have to look at the cash flow. Their free cash flow is negative $135.69 million, and net margins are at negative 8.39%.
Yeah, the cash burn is intense.
I mean, I have to push back on the hype here. Wait, they're burning through over $130 million in free cash flow with negative margins. How long can a company actually survive on future AI promises when the present-day vault is leaking that badly?
Well, if we connect this to the bigger picture, it actually makes sense for the sector. In tech hardware, especially during a ramp-up phase, massive initial cash burn is completely normal.
Really? Even $130 million?
Yeah. I mean, they are physically building out the infrastructure like that massive Texas facility to actually fulfill those $200 million orders. You have to buy the equipment and hire the engineers before you see the revenue.
Okay, so it's a massive capital expenditure cycle. They're spending money to make money. But if the financials are currently bleeding cash, and the future is supposedly this bright AI utopia, let's follow the money. What do the people closest to the company actually believe?
This is where the story gets really, really complicated.
I'll say, because I'm looking at the insider trading logs, and I have to drop a bombshell here. Over the last 90 days, corporate insiders have dumped 326,333 shares.
Right.
They cashed out around $29.4 million. Just in March 2026 alone, you had Director Elizabeth Laboa selling $9.8 million worth of stock, and Officer Joshua Ye cashing out $4.8 million.
The insider selling is definitely heavy, but, we have to look at the other side of the coin.
The institutions.
Exactly. Large institutional investors are absolutely gobbling up those shares. Institutions now own 61.7% of the entire float.
Wow, over 60%.
Yeah, and we are talking about massive increases in positioning from heavyweights like Vanguard, Invesco, and BlackRock. They are buying the future.
This is a classic paradox.
Yeah.
And I want to pose this to you listening and to you as well. If the people actually running the company, the ones seeing the daily factory yields, are aggressively cashing out of the top, but the smartest institutional money in the world is buying in, who is right? Are retail traders just being set up as exit liquidity?
It's the multi-billion-dollar question. And honestly, this tug of war between insiders cashing out and institutions buying in, it perfectly mirrors the massive disconnect we are seeing in analyst ratings right now.
The analyst landscape on this stock is bizarre.
It really is. The consensus rating on Wall Street is a mere hold. They score it a 2.29 out of 4, and the analysts are split right down the middle. You have 3 buys, 3 holds, and 1 sell.
A hold sounds so neutral until you look at the average price target. Because this is the shocker. The average target price from these analysts is $52.80.
Yeah.
The stock is trading at $150. That target implies a theoretical 64.9% downside from current levels.
And the range of those targets is incredibly wide.
Yeah.
You have Rosenblatt on the high end calling for $140, which the stock already blew past, and then you have another analyst with the target all the way down at $25.
25 bucks. That's a completely different company at that valuation.
Well, the valuation metrics themselves claim the stock is wildly overvalued. It's trading at 6.68 times its forward price to sales. For a hardware company, that is astronomical.
Totally.
Traditional models estimate its actual intrinsic value is somewhere between $78 and about $91.
So we're back to this natural human debate. Is this a true AI growth story that traditional valuation models simply can't price correctly yet?
Right.
Like maybe the spreadsheets are just broken when it comes to AI potential, making it actually undervalued?
Right.
Or is it just a classic value trap?
Right. The trap where retail traders hear the AI buzzword, buy the hype at the absolute top, and then just get completely crushed when reality sets in and drags it back down to that $52 target.
To figure out whether this is a trap or a generational hold, we really have to stress test the company's future. What is the absolute best and worst case scenario here? Let's start with the risks. Why do retail investors get trapped in these plays?
This raises an important question about their business model, because the downside risks and the volatility here are massive. The single biggest red flag in their filings: customer concentration.
Oh, yeah. This is scary.
AAOI relies overwhelmingly on a single, unnamed hyperscaler for its major orders.
A hyperscaler being like a massive cloud provider. Think Amazon AWS or Microsoft Azure.
Exactly. What happens if that one customer decides to pause their orders or shifts to a different technology? The revenue would vanish overnight.
It's like having a restaurant with only one VIP customer. If they don't show up, you go bankrupt. And there's another risk too, the dilution. They're using an at-the-market, or ATM, equity program to fund their manufacturing ramp-up.
Right, which means they're periodically creating and selling new shares directly into the open market.
Which actively devalues the existing shares that regular investors hold. It's like slicing a pizza into more pieces. Your slice just gets smaller. Plus, they aren't alone in this market. They face fierce competition from absolute giants like Momentum and Coherent.
Very well capitalized giants. So if we look at all these risks, let's map out the bear case first, the worst case continuation lower.
The nightmare scenario.
Exactly. In this scenario, execution slips. Ramping up complex manufacturing in Texas is hard. They hit delays or yield issues. Meanwhile, that single hyperscaler customer gets nervous and pulls back or delays their orders.
Which means the revenue doesn't show up.
Right. The cash burn accelerates, institutions panic and sell, the technical momentum totally breaks, and the stock price craters straight back down toward that $52 average analyst target.
Yikes. Okay, but to be fair, let's outline the bull case. The dream scenario. In the best-case recovery and growth model, AAOI flawlessly executes this Texas manufacturing expansion.
Which is possible.
Right. They successfully deliver on this massive 800G and 1.6T transceiver backlog without any hiccups. They prove their tech works at scale. Because of that, they hit that bold $1 billion revenue target, and they finally reach sustained profitability by, say, Q2 of 2026.
And if they do that, the current valuation might actually look cheap in hindsight.
Exactly. So we've looked at the meteoric momentum, the negative margins, the insider sell-offs, and these massive AI catalysts. So where does that actually leave us?
Let's summarize the outlook. If you are looking at the short term, the next few days or weeks, you really need to expect sideways consolidation or a minor pullback.
Because of that redlining RSI.
Exactly. The stock surged 53% in just 1 week at one point. Gravity has to kick in. But in the long term, looking out a year or two, the entire company's survival and growth completely hinge on successfully delivering its tech backlog. They have to prove they can be profitable by Q2 2026.
So what does this all mean? It means AAOI is one of the highest stakes poker games in the market right now. And before you place your bets, don't forget to like, subscribe, and drop a comment below with your take on this.
We really want to know if you think it's a trap or a buy.
Definitely. But I want to leave you with one final provocative thought to mull over on your own. We talked about how AAOI's entire $11 billion market cap rests almost entirely on the shoulders of one unnamed hyperscaler customer.
Yeah, that massive reliance.
Right. So who do you think that customer actually is? And more importantly, what happens to AAOI if that multi-trillion-dollar tech giant suddenly decides they have the resources to just build these transceivers in-house?